Hello everybody, welcome back to my channel where we talk all things finance and investing. In today's video, I thought I would do a part 2 version of my recent video on currency hedging in and around the most popular S&P 500 ETF in the UK known as VUSA. I did that video really with the view of pointing out to people why there's such a difference in VUSA in the returns year to date versus the S&P 500 overall. If you haven't seen that video, I'll put a link to it in the description. You may want to take a minute to watch that first and then come back and watch this follow-up video here now. I thought I would do a follow-up very quickly because a lot of people had questions on this, weren't too sure how it all worked, and I know the world of currency hedging, currencies in general, can be quite confusing. Okay, so in that video, I outlined the difference year to date and why the S&P 500, which has been up around 9%, and VUSA, the popular pound-denominated S&P 500 ETF, was down slightly, in and around 1% at the time of the video. And of course, I outlined the reasons for this being that the currency conversion at the time, the pound-dollar rate, say at the beginning of the year versus now, the pound has strengthened quite a lot against the US dollar, and therefore, because that fund is priced in dollars, converted into pounds for UK investors like you and I, the FX conversion rate will play a part, and as the pound increases in value against the dollar, it will take away from the value of the fund. One thing I didn't mention, which I'm glad that it got brought up in the comments, and I'm well aware of this anyways, but of course, if the opposite happens, it will go in your favor. So if the pound weakens versus the US dollar, then the currency conversion will go in your favor and the price of VUSA will go up, if for no other reason than the pound dollar conversion going in your favor. So in other words, if the S&P 500 on any given day doesn't move, it stays at zero, but the pound weakens by 1% versus the dollar on that day, then VUSA will move up by 1%. And of course, the opposite is true. And that is the nature of these products that are priced in pounds, but the underlying assets are in dollars, and there's no hedge put on top of it. There's no way to get around it. What you need to be aware of is that there's a currency risk there. It may go in your favor if the pound weakens versus the dollar, and it may go against you if the pound strengthens versus the dollar, as it has done year to date. The main thing is that you're aware of that and you're comfortable that that suits your portfolio and your objectives as well. Now, of course, if you're averaging into this product VUSA and others like that over many years, then the ebbs and flows and ups and downs of the FX market will naturally kind of work their way out, and it's less for you to worry about. In fact, many people don't think about it at all, and they average in over a long period of time, and they allow it to just kind of run its course through that period of time. And that's absolutely fine as long as you're aware that that risk is inherent in this and you're exposed to the pound dollar rate. But one thing you want to keep in mind as well, and I can tell you this anecdotally from a friend of mine who's in this situation. He's accumulated a lot of portfolio, getting close to his retirement now, and he's in unhedged funds all the way. And with the dollar having weakened so much year to date, he's very concerned about the impact on his portfolio going forward. So it may become something that becomes a bigger deal for you as time goes on. Now, you probably, like most people, the consensus view is that the pound will continue to weaken versus the dollar as it has for the last 20 or 30 years. And I don't have a clue. That's probably going to happen. It certainly feels like it. But the reality is nobody truly knows. But just be aware, if due to US government policy, the US dollar were to weaken sharply, as it has done year to date, perhaps due to a debt crisis, another global financial crisis, or whatever, it doesn't have to be mistakes on the UK government's part. It could be mistakes on the US government's part. And the US dollar were to weaken significantly due to some sort of crisis. And that crisis also led the S&P 500 to sell off drastically. Then you're going to get hit with both sides. So you need to be aware for that. Simple example. If there was a debt crisis, for example, and the US stock market sold off by 20%, but so did the dollar weaken against major currencies, especially the pound in this case, by 20%, then VUSA would be down 40%. And I don't think a lot of people are aware of that or even have any clue that that's factored into their equation and their investments. So just consider it. I'm not saying any of that stuff will happen. I don't see that as likely. Either I'm an investor in the S&P 500, but these things can and do happen. It wasn't that long ago that £1 got $2. So just be aware that it can happen and make the decision that's right for you. If you're more comfortable, then do a little bit of both. There's nothing wrong with that at all. Okay, I also thought I'd take a second, go to the VUSA ETF on the Vanguard website, because I think there's some parts to this which can be a little bit misleading if you're not too sure how all of this stuff works. On my screen here, we've got the VUSA fact sheet on the Vanguard UK website. And if we look and scroll down a little bit, just on the right-hand side, we see these historical prices here. And the way this works is simple. Vanguard produces a net asset value, or a NAV, probably on a daily basis. And all of that is the total value of the funds in the fund divided by the number of units. So you get a price per unit itself, the net asset value of the fund. And that's really the price of the fund. Now, as I mentioned in my first video, S&P 500, those stocks obviously trade in dollars. So Vanguard creates a NAV in dollars. Makes total sense. So as of Friday, August 15th, the NAV was $122.31. Now what they do is they just take that and they divide by the exchange rate of pound dollar to give you a market value today in pounds. And that is the rate that you or I would trade on during the day when the market is open. So as you can see right now, or as of Friday, the 15th of August close, the market value on the VUSA was £90.22 versus a NAV of 122.31. Okay, so how do they get those numbers? Well, 122, the NAV in US dollars. If we divide that by the price in pounds, 90.22, then we can see 1.3556. Okay, if we go back to a pound dollar exchange rate right now, which you can see on my screen, as you can see, it's 1.3504. There's slight movements in there. But the point is that's how they're calculating the price of this fund in pounds. They take the NAV in dollars, divide by the exchange rate, and you'll get a rate there published that you can trade off in pounds. Now, if we were to look at a bit of a back date and see what happened at the beginning of the year, so if we go all the way back to January, okay, let's take January 3rd. Okay, so as you can see here, we've got a NAV of 112 and we've got a market value of 90.43. So when you compare that to now, the NAV was 122.31. You can see that the market value of the fund has barely moved, yet the NAV has actually increased by around 9%. So that is the currency risk and the currency difference that you have when you buy those funds. Again, to reiterate, of course, if the pound had weakened versus the dollar year to date, then the opposite would have happened. The NAV value of the S&P 500 would have gone up, but also because the exchange rate went in your favor, it would have increased more on the market value. But the point here is you're exposed to that currency conversion rate, because that's all they're doing. They're NAV in dollars divided by the exchange rate to give you the market value. So as you can see, the market value has not moved much year to date, and that is the price that you're buying and selling at in pounds. That is the value of your fund. So despite the S&P being up 9% or so year to date, you're basically flat on that. Okay, there's one other thing I wanted to point out that might get people confused here. If you were watching my video last time and you thought, well, hold on, I'm going to go check my VUSA fund on the Vanguard website. You scroll down to the price and performance. You click on the summary here to get an idea what the returns have been like. If you go over to the year to date, you can see the NAV is up 8.42% and the benchmark is 8.34. Of course, they're tracking the benchmark, and the benchmark is the S&P 500 total return, as you can see here. So their NAV is up 8.4%. So that begs the question, why is this up 8.4%? Yet the value of the fund was 90.22 and 90.40 roughly on the 2nd of January. Clearly, your investment in the VUSA year to date has not moved up like the NAV that they are displaying here on this page. Why? Because they're showing the NAV in US dollars, the US dollar calculation in this bar chart here. So this is why you might get a bit confused on this, okay? It's the NAV in dollars, which personally, I don't think is ideal. I think people should see what it is in sterling because that's their actual return that they'd be getting invested in this fund in pounds. Of course, you can always use Google Finance, as I do and many others do for this stuff. I pop in VUSA, I go to the year to date, and lo and behold, my year to date figure on this is basically flat because it opened the year at 90.44 and it closed as of today at 90.37. And that is because the pound has strengthened versus the dollar year to date by around the same amount that the S&P is up, around 9%. Okay, so that's my video, part 2, pound dollar exchange rates, S&P 500, all very complicated stuff, but personally, I think this is stuff that everyone should really be aware of before they make a decision where to invest their hard-earned money. No sooner did I show up to work this morning and I overheard a sales trader on a phone call make a comment about how he's disappointed that his ETF in the S&P 500 is basically flat year to date when the S&P has been up around 9%, and it's time for him to get hedged. And that was without any conversation with me at all on this. So it's clearly something that's on people's minds, those who are watching the returns in their portfolio versus hearing the headlines in the S&P 500. But of course, just to reiterate, if the pound were to weaken, it will go back in your favor. So just be comfortable. It could go either way, and you'll always have to watch the exchange rate and your returns. So that's it. I hope you liked the video. If you did, hit that like button, subscribe to my channel if you haven't done so already. And if you want to know what's in my portfolio and what I do, because, well, I'm not interested in having the FX conversion risk in my portfolio. I think there's enough with stock market risk. I did a video on my one fund portfolio, so I'll put a link to that one up there. Click on that. I'll see you over there. And as always, I wish you nothing but the best in your savings and investment journey.